Hello and welcome back to the Investment Association and our latest IA Talks AI episode. Today we'll be covering a wide range of technological developments, starting with AI, but also looking at digital asset markets, the EU feeder data sharing proposals, and the implications of tech innovation on cybersecurity. Today's guest is Peter Kerstens from the European Commission. So he's the advisor for technological innovation, digitalization and cybersecurity at the Financial Services Department of the Commission. And clearly with a job title like that, you have a very wide remit, Peter. So thank you so much for joining us. Let's start then with AI, which I know isn't a specific part of your role, but clearly there have been a lot of developments in the AI space recently. And of course, the EU has been at the forefront of putting in a regulatory environment to both protect consumers, but also try to encourage innovation within the market. So perhaps we could start with the EU AI Act implementation. How do you think that has gone so far? And with the tech clearly developing alongside it, has that perhaps complicated matters?
It has complicated matters because AI very much is a moving target. So it's very hard to regulate something if the development itself is evolving. When the European Commission proposed the AI Act, general purpose AI wasn't a thing. We proposed it before ChatGPT and so on came out. So the original structure of the AI Act is based around applications and the riskiness of the applications. And the more risky the application was deemed to be, the more heavy the requirements are. And so, for example, in the area of finance, we have consumer credit assessment and life and health insurance underwriting assessments as high-risk applications of AI with a lot stricter rules than if you're not a high-risk application. Then general purpose AI came about and that needed to sort of be fitted into this structure because it was a legislative file that was ongoing in Parliament and Council. And that was done by creating an AI office that would oversee and manage the deployment of AI, of general purpose AI in the European Union. The AI Act is really a reflection of the importance we attach to European values being respected in technological development. But we also see developments in the rest of the world. AI is the conversation of the day, is the flavor of the day, even much more than blockchains and tokenization and what have you. And we really want to also play a leading role in AI. And therefore, we can't only come up with restrictions and requirements, but we also must enable industry players, industry participants to engage with AI, to gain the skills necessary to deploy it in a useful and productive way, either in back office processes or in front office processes. Really, no one can stand on the side. And that's why our policy on the AI Act is, on the one hand, yes, respect the values which we hold dear to, even if those values are not necessarily shared by other important players on the global stage. And let's face it, we have sometimes different values than others. But at the same time, we do not want to become the EU. We do not want the EU to become like an AI desert where nothing is possible, nothing is allowed because we are so attached to our values. So that's why we have the AI continent strategy, which really has sort of the idea of leadership and industrial policy almost, an AI industrial policy approach to it. So it's therefore the implementation of the AI Act is a very gradual process. We need to sort of see that we do not stifle innovation too much, but that really we enable the innovation. Some people have many questions about it, but I'd say, well, this is a fundamental piece of legislation, and usually it takes quite a lot of time for this to bed down. There's teething issues. People said, well, they agreed to one thing in Council and Parliament, and then when it comes to actually applying this in practice on the ground, this raises complex issues. It doesn't mean that we can't find an answer to these issues, but we have to look into how do we do this in the most efficient and effective way in the interest of the EU, in the interest of our competitiveness, but also in the interest of the protection of the values we hold dear to.
So you referred to a complex international perspective on artificial intelligence, different jurisdictions taking different approaches. And clearly, up until about 6 months ago, all of the models were US-based big tech firms who are deploying those. But more recently, we've seen some coming out of other jurisdictions at potentially lower cost, which will certainly change the AI model marketplace. What do you believe are the biggest opportunity areas for international coordination on AI? I mean, presumably there is some level of agreement at a principles-based level of protected consumers, but at a practical level, how does that actually play out?
Well, I myself am not that familiar with general policy coordination across all fields. I'm really have been a financial policymaker for most of my adult life, and so I'm focused on finance. And that means that international coordination on financial services policy, you're talking about either the Financial Stability Board, which is the G20 plus a few other larger jurisdictions, or the G7 finance ministers and central bank governors group and the groups working under that. Those are the two big fora for what I would call policy coordination. And then you have also the internationally regulatory bodies like the Basel Committee on Banking Standards, IOSCO for securities regulators, the IAIS for insurers, and so on. So these are the bodies where we meet our peers to coordinate on policies. And it will come as no surprise that AI has come onto the agenda of those bodies as well. Of course, these are bodies of international regulators who hold very strongly to financial stability. The Financial Stability Board is about financial stability first. In the wake, of course, of the financial crisis, that's why the emphasis is there. And so you could expect that when people meet in the context of a Financial Stability Board, they will be concerned mostly about the financial stability threats of AI. But lately I've observed, and I participate in these discussions, and I lead the drafting work on the FSB work on AI. I've noticed among my colleagues and peers from other jurisdictions an interest in looking at the stability risks of not engaging with AI, and a recognition that if we do not play our role in the development of AI and the financial sector is left out, that will create financial stability risks as well. So the idea that, oh, it is new, it's innovative, and therefore it's a threat to financial stability isn't the narrative. The narrative is AI is here to stay, it's transformative, it has enormous opportunities. So far, mainly in terms of efficiency and cost savings, I see less developments so far in development of new revenue for the financial sector. Hopefully that will come. I expect it will. I'm not creative or innovative enough to figure out how you could apply this to generate new revenue. I can see where the cost savings, the efficiency gains are, and that is being deployed, be it in customer interaction, be it in underwriting, be it in risk assessment, be it in fraud management. Basically, throughout the value chain, any vertical, AI will have a role to play. And we are seeing a great deal of coordination in IOSCO, in the FSB, in the G7, finance groups. And this is the first time I see a technological development being debated in those groups where there is a recognition that the technology is not only a threat or a risk, but is also a real opportunity. Much more so than, for example, blockchains and crypto assets, which were looked at much more from a risk perspective rather than from an opportunity perspective in these global settings.
And a fantastic opportunity actually for these technologies to converge or to be used jointly, which could transform the financial services market that we are operating in, but also have an impact on jobs and the skills that people need in order to provide those opportunities that you mentioned. How should policymakers prepare for changes in the job market to ensure that the people and the talent that's coming through are able to provide the best possible output for financial services?
That's a difficult one because I'm not an expert in employment law and jobs as such. But people should prepare for AI. They should not see AI as a threat to their job. Because if that's the way they look at it, it is going to be a threat. They should look at AI as an opportunity for them, learn how to use it, play around with it, see what it can do, what it cannot do, so that it enables you and empowers you and gives you superpowers as a trader, as a researcher, as an analyst, as a whatever you may be, as a compliance person in a financial institution. If you're going to look at AI as a threat to your job and your livelihood, that's exactly what it's going to be. You should just use it as a tool that enhances your own capabilities so that you can be a better and stronger version of yourself. And I'm very confident that financial institutions will want to keep people on staff that can actually work with and pull value out of AI tools. I do not think that we're going to, I may be wrong, but I do not think that we are facing a dystopian world where the employees of financial institutions, either back office or front office, are going to be replaced by computers, and that customers and clients will have AI agents, and that we'll just have a dystopian world where the consumer or the investor's agent talks to the financial institution's AI agent, and we can just go for a walk in the park. I do not think that's the future. Some people believe that's the future. No, I think that we're going to see people being empowered by and getting more capabilities through AI for more sophisticated interactions. That's where I think the future is. But I am a technology optimist. So that's what I'm forced myself to think. I have many colleagues who are technology pessimists and who think that AI will render lots of people jobless. If AI really kills your job, then you should wonder whether your job was really all that interesting to begin with.
Peter, please tell us about the aims and achievements of the EU FinTech Taskforce that you've been involved with.
Well, the EU FinTech Taskforce was set up, I have to think back now, this was in 2017, if I'm not mistaken. I started working on digitalization and cybersecurity back in 2015, originally as a bit of a lone voice in the Financial Services Department of the European Commission, which was still heavily geared towards regulation, financial regulation stability in the wake of the financial crisis. But we saw the spring shoots of innovation coming out, so I started looking into that. And we then created a FinTech task force in the European Commission composed of colleagues from the Financial Services Department, but also colleagues from the Technology Department, our Director General for Connectivity, as it's called, because FinTech to us was a convergence of finance on the one hand and technology on the other hand, and sort of bring this together. And one of my realizations at the time was, and I've often used this in speeches, is that finance used to be about money. Well, I'm Dutch, and there was a time that finance was about tulips, but that's a really long time ago. Finance used to be about money. I still think it is a fair bit about money, but most of finance now is about technology, data, and money. Yet the policy framework, the regulatory framework, is still very much focused and geared towards the money part. Counterparty risk, market risk, interest rate risk, all kinds of liquidity risks. These quantifiable economic risks, financial risks. And the technology part and the data part were a bit sort of aside. A self-respecting regulator would be focused on market risk, credit risk, traditional financial risks. Operational risk was not really something you were all that interested in as a regulator, unless you were regulating or making policy for financial market infrastructures and payment systems. These people have always been very heavily focused on operations, but the others, not really. And what the FinTech Task Force really brought to the fore was that finance and financial policy is as much about operations than it is about economic and financial risk and opportunity. And that's why the work programs of the European Commission that came out of this FinTech Task Force, which I co-chaired, led to work programs or digital finance strategies with proposals for policy just like the Digital Operational Resilience Act, which is basically the Cybersecurity Act for the financial sector, which really puts the cybersecurity standards and operational resilience standards at a very high level, because we have very high expectations of finance. Not because we have high expectations of finance, because people have high expectations of finance, because the financial world holds their money, their assets. So the highest standards. The financial sector was already doing very well, but doing very good is just not good enough. You have to do better to maintain the confidence. It also led to market in crypto assets regulation, which is the regulatory framework for crypto assets. It led to the DLT pilot regime for testing DLT use in traditional financial markets. It also resulted in our promotional work for sandboxing, and sandboxes are not only there for industry participants to experiment, but in my view are even more important for regulators to become familiar with innovation, so that they have a space where they can meet innovators, and innovators can show them what it is they're doing, what it is they want to do. And I firmly believe that regulators get much more out of a sandbox than the participants in the sandbox do. That's just my view. Another proposal which came out of our digital finance strategy based on the FinTech Taskforce was our Financial Data Act, FIDA, which really is a replication of the approach of open banking in the UK, or our access to payment accounts in our payments legislation, and expand this to all financial verticals. Really to empower consumers, to make consumers, put them in control, into the driving seat of their own data. Because let's face it, financial institutions are but the curators of the data, transaction data that consumers, businesses generate with them. The data actually belongs to the customers, and customers should be able to share their data with whomever they wish. That's already a principle in the general data protection regulation, but it's not really activated, operationalized. So FIDA really seeks to operationalize this so that the data can really be used for productive uses. There's a lot of pushback on FIDA. The typical position paper we receive on FIDA from anywhere in the financial sector is, FIDA is a wonderful idea for someone else. So please apply it to someone else, not to us. We think it's a wonderful idea for everyone, but if you are a financial institution and you look at FIDA just from the perspective that you have to give access to the data you hold, it's a losing proposition. You have to look at FIDA not only from the perspective of you being a data holder that must give access, but also you being a data user. You also get access to the data held by others. And if you want to be a financial institution in the 21st century, you're not only about the money, you're also about the technology and the data. If you do not have data, you can't compete. And that's why access to data is so essential. And that's why I hope that FIDA will end up being adopted more or less the way the European Commission proposed it, although the enthusiasm for FIDA is not as big as the enthusiasm out there in the industry, is by far not as big as my personal enthusiasm for it.
Well, let's move on to an area that perhaps does have more of a shared enthusiasm between private and public sectors, which is tokenisation or digital markets. We're here speaking today at the EFAMA Tokenisation Conference in Brussels, and you have just given a speech on how digital markets are going to flourish in the future and the need for industry and regulators to work closely together to make that happen. So perhaps for the benefit of the audience, you could explain a little bit more about what you were talking about there.
Well, John, in my speech, I emphasized that I believe that we are at the cusp of a new era of finance, an era of tokenized finance, where pretty much any asset, any financial asset imaginable will end up living on distributed ledger technology in blockchains. We're not there yet, but projecting towards the future, I believe that the power of this technology, the advantages, the efficiency gains that can be had are so pervasive that it would be irresponsible not to seize these opportunities, and that the markets should be moving there. And we must do so in the EU to really remain a vibrant capital market. If we do not do this in the EU, we are at risk of becoming a flyover zone between the developments which we are seeing in the United Kingdom, in the United States on the one hand, and the developments which we're seeing in the Middle East, the Emirates, and Southeast Asia on the other hand. We really think that the EU should be a stopover place and not a flyover zone.
So there's a competitiveness element to it. But you also mentioned efficiency and other benefits that can be provided to both the markets and end consumers. What, in your view, are the primary benefits for tokenization holistically?
The primary benefits or the shorter term benefits really lie in efficiency. If you look at a financial institution, be it fund managers or a large bank or an asset manager, and you look at their relatively tall office buildings they tend to occupy, you wonder, what are all these people doing there all day long? They do an awful lot of back office admin, reconciling of accounts, compliance work. And this is important work, but it's also a bit tedious, very costly, and it slows down the system. And by having straight-through processing based on a distributed ledger where all the participants work of a shared version of a common truth, you can dispense with an awful lot of this red tape, because that's really what it all is. You can do away with that. So I would say efficiency and cost savings in the short term, and that's important. And we're talking about, if I look at industry projections, billions of euros that can be saved in efficiency gains. But also tokenization allows for opening up new markets, in particular in illiquid instruments. But there's no reason why currently liquid instruments should also not be tokenized. Fractionalization is also mentioned very often. The distribution of your tokenized financial instruments on a global scale, because if they're tokenized, like a crypto asset, they effectively become tradable all over the world. Technically, there's nothing to stop you. There may be regulatory barriers to it, but from a technological point of view, there is no reason why a tokenized asset, tokenized in the EU, could not end up in some Asian venue. Some people may not like this, may find this very scary, but if liquidity is what people are after, and actually that's what they're always after, the more trading in your instruments takes place, the better it is, I would think.
So 24/7 markets could potentially disrupt the sort of 8 until 4 o'clock normal market hours that we have. The EU was quick off the block in terms of regulating, specifically on MiCA or for crypto assets, but also you put in place the DLT pilot regime. What is the current thinking within the Commission about how those have gone, what have the challenges been, and how do you think they will develop in the future?
Well, yes, John, the EU is never one to under-regulate an opportunity. Now, joking apart, we did MiCA, we proposed it in 2020 as a result of an agreement at the G20 level that no global stablecoin arrangement should start operating before a regulatory framework was in place. So the leaders of the G20 agreed that everyone should put forward a regulatory framework for stablecoins, and that's what we did with MiCA. At the same time, we already saw the promise of blockchain technology for other financial markets as well. And so we said we should start experimenting with this. And that's why we introduced the DLT pilot regime. MiCA was met with a relative degree of enthusiasm, and also people felt the need and the urgency of getting this in place because we had very large tech firms that were behind, that wanted to do this. And if we would not put a framework in place, they would do it anyway. So there was a lot of enthusiasm for MiCA. When it came to the DLT pilot regime, there was a lot less enthusiasm among regulators, but also among industry participants. Most people in traditional finance weren't all that interested in tokenization. And this is just 5 years ago. The result of this lack of enthusiasm was that the DLT pilot really is quite shy, both in the assets that can enter the sandbox, but also the thresholds below which you have to stay. So there's actually quite a lot of requirements and not an awful lot of flexibility in it. And while a lot of innovators expressed an interest in the DLT pilot regime, ultimately they opted not to make use of it, not to apply under the DLT pilot regulation, because technology had moved on, market practice, market interest had moved on, and people want to go for bigger, grander things. So we currently have only 3 projects that are approved under the DLT pilot regime, which of course shows that it works, but it really is not big enough. And we see that bigger players are either opting for national regimes, either in Germany or Luxembourg or France, where laws have been adapted to accommodate this, or they actually take their trials offshore and they want to experiment either in the UK, where they have a sandbox now, or in the Emirates, or in Singapore, Hong Kong. And now, with the change of administration in the United States, we also see the market opening up there. And as the barbarians are at the gate, we have our DLT pilot, which really isn't the right type of tool we need to also play a role. And that's why we want to come forward with a better pilot regime, a bigger pilot regime. And it's still going to be, or we think it still has to be a pilot regime, because we do not yet know where this innovation is actually going to lead us to. And therefore, we do not know at this stage what rules we need for the future financial markets. So that's why we want to continue with a pilot regime, a much more expanded one, to really get to grips with what does this create in terms of market dynamics, in terms of market risks, in terms of a market's behavior, so that we can shape our future regulatory framework in a much more informed way. Today, we don't really know what precisely is necessary because we do not know what the markets will look like. And we've asked everyone, what do you think the markets will look like 5 years, 10 years from now? And other than, well, there will be an awful lot of tokenization, I don't get more than that.
Earlier, you mentioned about stablecoins, and I know that a digital euro is also being thought about at the moment. How important is it, do you think, to have central bank money available on chain in order to provide the cash leg for settlement of these transactions?
I think it is absolutely essential. Now, there are 2 versions of the digital euro. There is a lot of debate about a retail digital euro, which really would be as an alternative payment system operating on public money to compete with payment card networks and so on. That's one digital euro. But when I talk about tokenization of financial instruments and a digital euro for that, I'm talking really about a wholesale digital euro. And yes, technically, you can settle transactions, debt transactions, equity transactions, fund transactions. Technically, you can settle them in stablecoins or in tokenized commercial bank money. You could do it, although it's not always that easy. But at scale, I do not believe that there is any stablecoin issuer or any bank or group of banks that can generate enough cash on ledger to meet the needs of financial markets. Only central banks have the elasticity to meet the liquidity needs of tokenized financial markets, which run into the trillions. So you need a lot of cash. Only central banks have the elasticity. And also, only central banks can issue a version of cash that is risk-free. All the other versions of cash, even if they're fully collateralized, always contain some element of risk. Indeed. At a small scale, it doesn't really matter all that much. But at large macro scale for financial markets, I do not think, and I do not hear any industry participants who are very comfortable in settling such transactions in private money. They really want to settle these things in public money, in central bank money. And the question is, should this be central bank money on a distributed ledger? Should it be tokenized central bank money? I'd say, well, why not? I would say, why not? This may be a step too far for some, or at this stage a step too far. What is key is that central bank money is available in a format that is compatible with distributed ledgers. Whether it is on a distributed ledger or not, that is open for for discussion. We'll see how that evolves. But it has to be central bank money that can really be used to settle on-chain, because if you can't settle on-chain, there really is no point in moving the assets on-chain and trading them on-chain, because it's only half of the story. Yes, you can get some efficiency gains, but you really are limiting yourself and excluding the biggest part of the efficiency gains that are to be had with tokenization. So yes, central bank money, a digital euro, is absolutely essential. And if we do not have that, we do not have an awful lot of commercial bank money denominated in euro online. We have hardly any stablecoins denominated on euro online. So we may see settlement taking place in dollar instruments. And I think that is also undesirable for European markets.
Very similar conversation in the UK at the moment. Obviously, we've seen the US move on this and explicitly ruled out a central bank digital currency and really seeking to provide US dollar dominance. But again, very few numbers of GBP, sterling denominated stablecoin, and wholesale CBDC is currently being looked at by the Bank of England. So huge amounts of developments. This is a very exciting area. Cybersecurity is also under your remit. When you look at the suite of emerging technology, we've mentioned tokenization, blockchain, artificial intelligence, sharing data more widely across the industry and for the purpose of the benefit of consumers. What are the implications on cybersecurity as all of these technologies are utilized within financial services?
A lot of people think that security or cybersecurity is a physical notion, that you can't distribute the data, you shouldn't have it in the cloud and so on, or you shouldn't have it on distributed ledgers because that's insecure. They say you should have it air-gapped in your basement with walls around it, and that's wrong actually. Security in the digital age is a logical concept, it's not a physical concept. So people who come forward with location requirements, we need to know where the data are getting it really sort of wrong. It's a logical concept. And as systems are more open and distributed, they are more resilient. So if we look at, for example, blockchains, like you can have all kinds of views on them as to whether good or bad, but what you can't say is that they're not resilient. The Bitcoin blockchain has never ever had a downtime. It's never been hacked. I do not know of any single IT system operated by any financial institution that has operated that well. So this is the clear example of resilience. But it requires a different approach. A lot of people think that cybersecurity is a physical notion. It's not. It's a logical concept. But also that it has to do with the technology. Yes, technology is important, but much more important in security are processes and people. The weak spot in cybersecurity when there is an attack somewhere is almost always the human error, human weaknesses. And we can't really, we can try, but our only hope to overcome human weaknesses is technology. So rather than slimming down on the technology, we must double down, because technology doesn't make the same kinds of mistakes humans do. It doesn't have the vulnerability, the psychology, the emotions, the bad moods, whatever. So I am a technology maximalist also on that front. And what our cyber resilience, operational resilience work has done, our DORA Act really has done, it's a coming of age of operational issues in a financial institution. When we were preparing for DORA, I would go around large financial institutions and I would ask them about the composition of their C-suite, which is this American expression, like who's in your C-suite? And it would be, oh, you got the chief executive officer and the chief finance officer and the chief risk officer and the chief whatever officer. And I would say, and where is your chief technology officer and your chief information security officer? And very often the answer was, well, he or she is not in the C-suite. He or she is not in this building, because imagine they were in this building, we would run the risk of having to share the elevator with them, and they would having their elevator pitch on one or the other technology issue, which we do not want to know about. Because finance is as much about technology and data as it is about money, it is absolutely essential that the operational security resilience function ends up in the C-suite. And so if the DORA, Digital Operational Resilience Act, does one thing. It is to make sure that the top of the company owns the operational risk. If they do not understand the operational risk, because that is not how they made their career, because they usually made their career by being traders or bankers or whatever, and that's fine, there's nothing wrong with that, but that does not necessarily make them good operations people, being really on top of the game of what the operational implications, security implications, performance implications of these technologies all are. If they are not on top of their game, they should surround themselves with people who are on top of their game, and they should make sure that these people are readily available to them, so they just have to walk across the corridor to talk with them, or they would see them on a daily basis and not occasionally on some video call from some data center where these people are located. I paint a bit of a caricature, but this is a lot of what we saw, is that a self-respecting finance person would not want to deal with an operations person. And in the current day and age, finance is all about operations.
Peter Kerstens, self-described technology optimist. It's been fantastic to speak with you today and to hear all the fascinating policy discussions and developments that are happening in financial services. And we look forward to working with you as those transformational impacts occur across the industry. So thank you again, Peter, for coming in to talk to us today.
Thank you very much.